Dow was down more than 1,000 points, driven by uncertainty about the health.
From record highs to market meltdown in less than a week. Australia's major companies will be reporting their profits against this backdrop, so expect some big falls in their share price if they fail to meet investors' lofty expectations.
What we're going to see is a range of sectors across the Australian equity market report earnings contractions versus the year before. Whether it's the energy companies, the miners, consumer staples, and also banks. They're coming off what were record and unsustainably high profit levels a year or two ago.
Back then, interest rates weren't as high as they are now, and consumers on average had a bit more money saved up.
I think we're almost empty when it comes to the savings buffer across certain demographics, and so that has to come to the fore and come through earnings at some point.
Companies like JB Hi-Fi, Lovisa and Flight Centre will come under intense scrutiny.
Consumers' discretionary will hold up better than what others expect. And Australians are still buying technology. They're still upgrading their phones, they're still buying televisions or computers when they need to.
Many retailers have had to lure in shoppers with sales that never seem to end. But these discounts will eat into their profits and probably their dividends. And given concerns about the broader market being overvalued, it wouldn't take much to trigger a sell-off.
And when we look at earnings growth, it's looking relatively mediocre at best. It might be 3 to 4%, I would say, is a bullish scenario, and valuations are high.
The drag on overall earnings for the Australian equity market will be the energy sector in particular, where there's been a big step down in profits.
And there are a lot of analysts who say shares of Commonwealth Bank, which have surged 25% over the past year, are ripe for a fall.
And it's certainly one of the most expensive banks in the world. And look, to keep up this valuation, its earnings would need to grow, and it's been quite flat in terms of its earnings.
Companies like Helios and Sonic Healthcare, whose profits were boosted by millions of COVID tests, may also come under pressure.
It is a thematic that I would really like at this point in the cycle, but when I look at the stocks available to us, we just don't see any that really scream opportunities.
Opportunities may also be slim for mining profits as demand for commodities from our biggest trading partner slows down.
What we've seen emerge over the last 3 to 6 months in China are the baby steps towards a debt deflation spiral. And it explains why some companies like BHP are seeing their share price down 20% year to date.
Despite the gloom, insurance is one sector that almost everyone agrees will report mega profits.
It is offering really strong growth at reasonable valuations, and that is quite hard to come by.
It also helps that insurance premiums have shot up dramatically, far above inflation, and it's not a service people can easily opt out of. Now looking ahead, all eyes are on the US tech sector and whether the artificial intelligence boom, which has driven global markets to record highs, can keep going. Nvidia, in particular, is seen as a barometer for market exuberance. Since January, its share price has doubled, taking its market value up to $3.7 trillion.
We think, possibly, that the AI theme could be nearing an exhaustion point.
Big tech has had such a huge run since the start of the year, so there's a lot of focus on mega cap tech earnings in the US, and any downgrades there will certainly impact the market in Australia and the US.
But the biggest source of volatility is likely to be the race to the Oval Office.